Canada, we have about 75% of customers getting mortgages through the banks. Another about 10% of customers getting mortgages through credit unions, Caisse Populaire. But there's about a 2% segment of the market that's typically self-employed or a new immigrant to Canada, and they just don't meet the bank income test. So a solution was required in the early days for these people that don't quite meet the income test but have a large down payment. And we were able to get investors together to be able to participate in that mortgage, in that market, and lend directly to these people. People were using their RSPs to fund mortgages. So I would actually find you a private second mortgage or a private first mortgage, and you would put that into your RSP. Later, moving on into sort of the 1990s, our investors were looking for more of a pooled product. They were looking for more diversification, more liquidity, and we started up a mortgage investment corporation, and that was able to provide all those benefits like diversification, liquidity that all of our investors look for today. We like to diversify the portfolio over provinces, British Columbia, Alberta, and Ontario. And really what we're looking at trying to do is create a product that is as safe and secure as we can make it, with getting as much yield as we can, with that safety and security. Lending in major centers of Canada. We try to avoid smaller centers. Major centers have just much more of a diversified economy, and when troubles hit, we tend to find foreclosure process much easier and recovery much easier lending in major centers like, let's say, Greater Vancouver, Greater Toronto, Calgary, and things. Historically, more expensive properties have been much more volatile with regards to price. Let's say anywhere from $400,000 to say $1.2 million as far as value goes. Those properties historically have held up a lot better with regards to price. I mean, everyone now is embracing the endowment fund and pension fund model, right? In which case, portfolios are tilting more and more towards alternative investments. So I would argue is ideal for every investor, for younger investors or more risk-averse investors to have more, less of a fixed income component, and for investors that are not, risk-loving, maybe older clients or people that are on a fixed income, they may want to have more of a fixed income sleeve. So the more risk-averse the client, or the older the client, or the more steady income they're looking for, may fit that criteria of the quote-unquote ideal client. I think in general, what we're seeing is the effects of supply and demand in our market, which is the private mortgage market. Private mortgages on residential real estate tend to hold up very, very well in times of market turmoil. So let's just say, terrorist attacks or the corporate governance issues we had, or the tech blow up in 2000. The financial crisis, 2008, 2009, and now COVID-19. During all of those situations, our asset price didn't change, and we continued to pay out a reasonable yield. So people have learned over time that this is a great investment, and we're just seeing more and more inflows of capital into our market.